and we'll keep coming back to you. Adrian Mowat is now joining us. He's a veteran, looked at global sort of macros, markets for a long time, and of course based out of Hong Kong now. Adrian, good to have you with us here. Thank you very much. So the market here in India has been one of the better performing ones globally. Actually one of the best performing ones, not even better. So one can, some corrections, some pullbacks, etc., do come in from time to time. This could be one of them. My question to you is that apart from that factor, which is like a routine pullback, is something sort of happening in global markets which we should sit up and take note of. The dollar has been higher against, I think, widespread expectation. Yields across the curve in the US are hitting new highs, at least on a closing basis. So just wanted that perspective from you. What's going on?
Yes, I think, you hit on the key factor here, which is the bond market. And so we've had a bond market where the yield curve has been the most inverted that we've seen since the 1980s when Volcker was in Powell's position as chairman of the Fed. Now, at one point, Volcker had pushed the Fed funds rate to some 20%. And so you ended up with a yield curve that's inverted by about 1.5%. Now, today, obviously, we have high Fed funds rate, but they're high at 5.5%, not at 20%. And we've got a yield curve that has a bond, has an inversion of about 1.1%. Now, that seems extremely sort of bearish in terms of the economic outlook. If you feel that, yield curves really indicate what's going to happen with the economy, I would suggest that the yield curve is wrong, that the U.S. economy is proving to be more resilient. And so the pain trade for this year has been for the bond investors. So all the sort of major government bond indices are down year to date. And the pressure is for investors to take money out of bonds. So I think yields will push higher. And as yields push higher, that supports the dollar. It is less competitive as this discount rate moves higher. So I think that's an important pressure point. I'd also, add that, the pessimism around China, if anything, is building some momentum. And, India is an emerging market. It's a major emerging market, but the largest emerging market, even with the underperformance of China, is China. And so when you talk to emerging market fund managers, they are seeing redemptions. I think India is part of that story. Before you get overly pessimistic about that, it's very important just to come back to your local fundamentals. You have one of the stronger economies in the emerging market. You're the fastest growing major economy. You don't have a particular issue with inflation, and your current account looks okay. Maybe there's a little bit of short-term pressure as the oil price moves higher. So I think India is sort of suffering a bit of collateral damage rather than specific issues for India.
Adrian, this is Rima here. You said emerging market funds are seeing redemption pressure and India is a part of that. Do you want to put some numbers to the extent of outflows that we've seen from emerging market funds, and the collateral damage, therefore, that India has been facing? And secondly, have you been following the news flow that, there are some rising tensions between India and Canada? Is that in any way affecting the Indian equity markets and the fall that we're seeing, for instance, today because of the escalation?
So for the latter one, I don't believe so. I think the economic relations between Canada and India are more modest than other bilateral trade points. So equity investors tend to look through these situations. I don't have to hand the exact numbers for emerging market outflows, but they are definitely outflows. And remember that quite a lot of people buy into passive products. So they bought emerging markets through an index product. So as China drags the indices lower, then that drives, broad redemptions, which India will get hit by. It's interesting, if you think about some of your big global blue chip stocks that have ADRs, such as HDFC, to some extent, you're seeing more pressure in these, classic holdings for big long-only funds.
Hi, Adrian. Adrian, I recall when you joined us last, you said that India could be in a phase of consolidation post the recent run. Do you think, given the kind of cues that we're getting from the Fed, the global setup as well, crude oil prices moving up, could it now be in for a bit of a correction?
Yes, I think it's quite possible. I mean, for fear of being sort of overly focused on calendars, seasonally, September, October can be periods of consolidation in global equities. India's had a good run. People are sitting broadly on some profits there. So it's probably tactically vulnerable. But I go back to my previous point. It's, for the long-only investor, you probably should be looking through this. I'm not sure if it's a big enough tradable pullback.
Not a big enough tradable pullback. I mean, so basically, more like a short-term whipsaw, Adrian.
Yeah, so I think there's this pressure which goes back to the fact that the U.S. economy is proving to be quite resilient. Inflation is falling, but it remains above the level that the central banks are comfortable.
Right. Sorry, are you there, Adrian?
Can you hear me? Can you hear me?
Yes. Please go on.
Hello.
I thought Go on, Adrian.
Yeah. So there was too much. There was too much a consensus around the U.S. economy slowing down and the Fed cutting rates quickly as we went into 2024, and so we're readjusting that outlook. So there's a bullish part of that outlook, which is that the economy is better, and the bearish part is that short-term interest rates are going to stay above 5% for longer than the bulls on the monetary cycle we're hoping for.
But okay, got that. And you were just to sort of you said that it's most likely the case that the yield curve inversion in the U.S. is you said you believe it's wrong. I mean, it's not. In that sense, this time is different. It's not indicating a recession.
Yes, I think it is wrong, and I think it is wrong because we are moving from the post GFC, post-Euro crisis period of expansion in central banks' balance sheets, European Central Bank governor doing whatever it takes, to one in which we've got the quantitative tightening, a shrinking of balance sheets, inflation above central banks' targets, deteriorating fiscal positions, and those that are anchoring on the bond yields that you've seen since the early 2010 have got it wrong. And I think it's that anchoring behavior that's got long-term bond yields at this level, rather than some, divine view about how the economy is going to turn out in the United States. So the pain trade is that bond yields are moving higher and that the yield curve shouldn't be inverted at this stage.
Adrian, great conversation. Thank you very much for joining in. In fact, let's stick with this story.